Hello, my name is Witchell Joseph. Welcome to Trading the Markets. Now, I'm not a financial advisor, so everything here is for educational purposes. But tap in with me as I dive into the state of the market, state of a potential crash, how it can perform, and levels to look at. And public announcement, I normally do classes on Monday and Tuesday for free, and Wednesday is the paid class. But Monday will be my only class this week and next week, as I will be on vacation. So I will not be having classes for the rest of this week, and next week will be canceled. So tap in definitely to this video and to tomorrow's class, because it'll be very special as I leave you guys off with a clear guidance of what to look out for and how to take advantage of it. So tap in. So without further ado, we're going to dive right into the SPY, which is the S&P 500, which is the market. All right, so as you guys see from my screen right here, so this is SPY on the monthly time frame. So SPY is S&P 500. This is the ETF that tracks it. Now, notice that every bar here represents 1 month, and you see goes back years, right? And one thing you notice that the market kept going up until recently. You see how crazy the market has been falling this year. But the main thing is this, right? So we're trying to tell the levels of where it might fall, where it might bounce from, where it might reach. So the way to do this is to use what's called Fibonacci retracements. Fibonacci is like it's a number sequence found in nature that actually coincides with a lot of things. So let me bring up my indicators. All right, so the way to draw them, you find a swing low, which is a very low point before the trend changed. So from here, these lines came out because I had already drawn them, and you draw it basically to this swing high, right? So so what you'll notice, well, let me stretch this out a little bit. So what you'll notice right here, all I have to do is hit the high, and what matters are these numbers right here on the left. So this right here is the 38.2% retracement, and as you can see, we've crushed it. We passed that. So the next level down is this 50% retracement level right here. And as you can see, I already drew a line there. But basically, I've drew a few lines to coincide with these levels. So first level is that 50%. So based off Fibonacci, the golden ratio, the golden place where price may bounce would be the 50% level, which we are approaching, or the 61% level, which is down here around 318. So we're gonna watch that. And also I made a level right here at 338, which is the highs right before the pandemic. So these are the pre-pandemic highs. So this is the monthly, right? Now I'm gonna take away the Fibonacci's now that we have our levels, right? So I want you to notice this candle right here. It's what's called the inverted hammer. It looks like an upside down hammer, right? Now, things to notice about this upside down hammer is that it has a strong body. So now if you guys know anything about candlesticks, red goes down. So the body represents the open. This is the open. So this is a monthly. So it's open in September at 392.76, and it closed September at 357.20. So that's a big, strong red candle. And what you'll notice is that it has this stick right here, which is called a wick, which means that at some point in the month, it made a high at $411. Now, this is showing a big rejection, and this is showing us that we're in a downtrend because we're making lower lows and lower highs. Like, let me just annotate it. So right here, you guys see it. These lows are getting, the highs, lower highs, and lower lows. You guys see that? So that is how you know you're in a downtrend. So another way, you can use the moving average. So that blue line right here, right there is the 50, but let me put out the pink line, which is the 200. So boom. Let's see if it'll come back. Hold on. Sometimes it'll annotate. I should have left it on. I think it's on. Let me see. All right, there's the 50. There's a 200. There we go. I'm gonna have to do one at a time. Hold on. So going back to the monthly. So you see the 200 day moving average. So 200, it just takes the last 200 bars. This is 200 months because we're on the monthly, so it's 200 month moving average. But I just call it 200 moving average. So it's a moving period of time. So you notice that it's been support, and basically when the candles are above this 200, we're in an uptrend. When we're below it, we're on a downtrend. So this is a long-term uptrend. So we're still in a long-term uptrend, but let's cut the trends up a little bit more. And this 50 is also another way for you to know. This 50-day moving average right here, as you can see, it's offering support, and it's been offering support for many months, even back in 2011. But right now, we're actually closing below it. And as you see, the times that we do close below it, we do have the potential to fall even more. So let me look at the weekly. You're doing the top to bottom approach. I'm going through it real quick for you guys. So as you can see, the 50 was a resistance. It was a ceiling that it bounced down from. But if I pull up the 200, so now you see that price is closing underneath the 200 weekly moving average, right? So now notice that this doesn't happen too much, but whenever it does happen on the weekly, price has been known to fall an additional 30, 40%. So if we don't bounce soon, this could really turn uglier. That's basically the point of that. And if you look at it, this is like a mirror of the monthly. You have another inverted hammer, another strong bearish candle. We're closing at the lows, so it's showing that the bears are in control. So now let's really get into the nitty-gritty off the daily. So now if I go to the daily time frame, there's the 200 there. The 50 probably is a little bit more relevant, right? So that's the 50 period or 50-day moving average. Now that we're on the daily chart, again, all it does, it takes the last 50 candles, creates an average of where price would be based off the average. So now these gray areas represent the expected move within the week. And the way that I know that is basically from going to Thinkorswim. So real quick, you go to Thinkorswim, you go to SPY, you go to the weekly contract expiring this week, Friday, October 7th. You come over here, you see it saying 37.46%, also plus or minus $12.06. So therefore, they're expecting SPY to either move up $12.06 or move down $12.06. And that's how I drew that area right there. So going back to the chart. So as you can see, SPY actually stayed inside the expected move from last week. But I want you guys to realize that all before that, all before that was strong moves. And basically this is what you call, so the market goes in two stages. It's either in expansion or it's in contraction. So it was an expansion when it goes in one direction hard. And it was an expansion. And then you see right here, now we're back in contraction. And furthermore, there was even a consolidation right here where the market broke out underneath, which means that this could be a bear flag continuation, potentially. But do not expect anything out of this market. Do not just short, do not just chase. You got to wait for structure, wait for confirmation, get the best entry, make the best guess that you can. Because the market is very volatile right now, and it can really go both ways. And you can really get chewed up if you thinking that it's going to go this way within this time. So the main thing is this, if you guys notice this orange bar right here, this represents the gap that we have failed. As you see right here, it attempted to go, but the fact that it failed and didn't find any acceptance up there really is showing that the bears are in control. Another reason why bears are in control right now. And mind you, we're not trading based off how we feel. We're trading based off what we see. And until I see something different, I'm just going to go with the higher probability. So now I cannot be bullish until we can get through this zone. Then I can think about us really doing something to the upside. But that doesn't mean that we can't have a bounce, because we haven't made a dead cat bounce. And in case you guys don't know what a dead cat bounce is, is basically a stock term that says that even a dead cat that falls from a cliff bounces after hitting the ground. So we might find a little bounce. Either we retest this level right here and then keep going lower, or we may even come back and retest this area right here. But if we do not break through, we will most likely keep going lower. Excuse my drawing. So these are the scenarios that may really, really happen in the SPY. We may even come down here and consolidate, make another bear flag, and then keep going lower. But definitely, if you want to short this, I would definitely look for a retest at least up until here, because then you can put your stop loss above this, because this was the area where price did not find acceptance, and it may reject this again and not find acceptance again. So interesting. We're going to see how this plays out, but definitely be on the lookout. Be ready to play SPY on the levels and tap into class Monday so I can continue and show you how to take advantage of this, especially when we see what happens tomorrow in this new monthly candle. So that's it. Thank you for tapping the class. Again, I'll be on vacation. So tomorrow is the last class before I go on vacation. Thank you for tapping in, and I'll see you guys in class tomorrow.